My name is Ron Feldman. I'm the Senior Vice President for Supervision, Regulation, and Credit here at the Federal Reserve Bank, Minneapolis. And today I'll be talking about banking conditions in the first quarter of 2012. Before I talk about conditions, let me give a little background on the 9th Federal Reserve District. The 9th District is made up of the states of Minnesota, Montana, North and South Dakota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. And we have roughly 700 banks in the district. And I'm going to be reporting on conditions based on publicly reported data. And as you can see from this URL, we have lots of banking data available on our website, far beyond what I'm going to cover today. So I would encourage you to take a look. I'm going to make 3 points about conditions as of the first quarter. First, I'm going to give you a long-run vision for where we're at. That is, how does first quarter 2012 compare to the 20-year average and the 20-year median? In short, asset quality is back to historic norms. Profitability, however, is a little off, and loan growth is way off. And I'll cover that as I go through the slides individually. I'll also cover the first quarter performance directly, which was mixed. And then finally, I'll talk about a comparison across the states. And the main message there is that the Dakotas are very strong relative to the rest of the district. So let's move into the first quarter. Asset quality was relatively flat to declining. So let's take a look at a picture of that. Here we're looking at a measure of asset quality that looks at loans that are not paying or past due and delinquent relative to the financial resources that banks have to absorb losses from those loans. And as you can see, that number went up, which means things are getting worse. Now, the interesting part is even with that getting worse, you can look at the 20-year average and the 20-year median, and you can see that the current observations are very close to those long-run measures. So in that sense, asset quality is really out of the financial crisis. So that's sort of the downside of quarterly performance. Let's look at a couple of more positive areas. First, we're going to look at profitability. And pretty consistent with what you see every first quarter, you're going to see increases in profitability. And I should say there's also a seasonal pattern in asset quality, which I just covered, which is asset quality tends to get a little worse. So profitability is up, but you can see it's still far off the 20-year average and median. What's driving the increase in profitability? Per this next slide, it's a reduction in provisions. And provisions are the more or less technical term to describe monies that banks put aside to absorb future losses. And they look at this each quarter. Now, this has a very strong seasonal quality to it. Almost always you see provisions falling in the first quarter, which leads to profits to rise. So on the one hand, it's good that profits are rising. That's a positive side. On the other hand, we would prefer to see the growth in profits coming from strong core earnings, as opposed to just putting less money aside for future losses. How about year-over-year loan growth? Here you can see that that's actually turned positive for the average bank in the district. Now, it's way off where it normally is, but still, it's the first time it's been positive for several years. The median is still negative. But it's going on an upward turn, and I'm expecting it to continue in that vein. Another way to look at loan growth is to look at the percent of banks that have positive loan growth. And that's now at 50-50. So again, it's positive. It's really far off what we normally see, which is almost 30 percentage points higher. But we're moving in the right direction in loan growth. So let me summarize for the first quarter. It was mixed, a little decline in asset quality, improvement in earnings, but not from a really core earnings, and some improvement in year-over-year loan growth. Now let's move on to compare across the states. And here I want to say thank you to some video watchers of these videos who noted that we were not including the western portion of Wisconsin and we were not including the Upper Peninsula of Michigan in these comparisons. And we'll be doing that going forward. I'm just going to show you a couple of comparisons, and I think they do highlight the real strength we see in the Dakotas. Here we're looking at the same asset quality figure, and you could see in the orange and green lines that the Dakotas are the strongest in asset quality, and Montana and Wisconsin the worst. And I don't want to leave a bad taste in the mouths of our viewers from the UP or Wisconsin. Here I'm going to highlight an area where their banks are the strongest, and that's capital. And here, North Dakota is the worst. Now, this makes a little bit of sense. I already noted that Wisconsin, for example, has weak asset quality, so they're compensating by having higher capital. Overall, again, it's really a story where the Dakotas are almost always going to look the strongest relative to the rest of the states in the district. And I'm going to conclude by showing you where we're at relative to a forecast that I made last quarter. As you might recall, I made a forecast for where we're going to be at the end of this year in terms of asset quality, profitability, and loan growth. And here I'm going to show you Minnesota, although we made these forecasts for Montana and the Dakotas as well. Now I want you to look at the square that shows you the forecast range for the variables. And I made a forecast for profitability, loan growth, and asset quality. And the dot is showing you the current observation. And as you can see, for profitability and loan growth, we're already within the forecast range. We're not for asset quality, but as I've already mentioned, asset quality tends to get a little worse in the first quarter, so I'm not surprised. And my expectation would be that these forecast ranges continue to hold, but we'll have to see at the end of the year. So let me sum up. In the first quarter, it was a little bit mixed. Asset quality a little worse, profitability a little bit better, but largely driven by provisions, and loan growth a little better. We're back to historic norms for asset quality, so in the long term, that's good. And I would encourage all of the viewers to continue to provide feedback. We find it very helpful, and we'll continue improving these presentations. Thank you.